Good morning. I'm Colin Bose Carlson. I'm the general counsel here at the department. I'm going to spend a few minutes this morning talking about sort of general legal issues and a few cases that we're watching. I'm thinking of this as sort of a preview of what some topics might be for discussion at other meetings like this in the next year or two. What are the things that we're going to be talking about? And of course, on that, I have to start with Pepsi. Although, for a change, I'm not going to focus on the facts of that case. The director mentioned in his opening remarks that we encourage feedback. And one of the recent feedback that I got actually at the TFI conference was that I should focus less on our wins. So I'm not going to get too deep in the weeds on this. We do pay attention to that. So if anyone wants to argue about Pepsi, we can do that after the presentation. But for now, I'm just going to give sort of a procedural update as to where things are and sort of how this fits into some broader context. I think that this is a case to watch because it should be important to any taxpayer who excludes profitable entities from their Illinois combined unitary returns under the 80-20 rule, particularly in Illinois, obviously. But there are issues like this that bubble up in other places as well, and I think we're going to continue seeing that. The Pepsi dispute in particular, it's in multiple places at the same time. Earlier audit years were at the tribunal, have been appealed to the First District Appellate Court. Some audit years remain at the tax tribunal. And just last Monday, we concluded a bench trial in Sangamon County on later years. So it's in a lot of places. I don't think it's probably going to be resolved anytime soon. So again, with my crystal ball, sort of thinking about where maybe this is going. I think it's important to take a step back and ask what is an 80-20 company? Why do we have these rules? What are they intended to achieve? And at its base level, an 80-20 company is a domestic corporation subject to federal tax with at least 80% of its business activity overseas. And the genesis for these rules goes all the way back to the U.S. Supreme Court's decision in Container Corporation, which was a 1983 case that upheld California's worldwide reporting system. And by the time that decision came down, there were about a dozen states that had adopted mandatory worldwide combined reporting, and the feds started to threaten federal preemption of those states' requirements. And so states sort of backed off, reversed course a little bit, and we ended up with mostly Water's Edge combined reporting, and 80-20 rules were part of that regime in many states, including in Illinois. Those rules in the states that they exist, they do vary a little bit from state to state. So in Illinois, we define an 80-20 company as an entity wherever it's incorporated or headquartered, whose business activity is 80% or more outside of the United States, and we measure that by property and payroll. And of course, we're actively litigating application of that rule now with Pepsi, but for the sake of looking at the bigger picture, I think it's helpful to look at how this has sort of played out in other states to try to get a sense of how policymakers here might be thinking about it as that litigation trickles through. There was a case in Minnesota back in 2010. The Minnesota Supreme Court weighed in on an 80-20 case involving the exclusion of a Minnesota corporation from a taxpayer's combined return. That case involved a captive REIT structure with income flowing to a domestic corporation with more than 80% of its property and payroll in the Cayman Islands. They also looked at property and payroll like Illinois. And the Minnesota Department of Revenue looked at the transaction and said, doesn't have any economic substance, doesn't have any sort of business reality, we can disregard it. Sounds sort of familiar to some people. The tax court agreed, but the Minnesota Supreme Court reversed and said that the revenue commissioner in Minnesota didn't have the authority to disregard that transaction structure. So then what happened? Does anyone know what happened? Minnesota just repealed they repealed the 80-20 rules. You can contrast that with what happened in Colorado, though. There was a similar case. Court in Colorado weighed in on this and ruled against the Colorado Department of Revenue in favor of Target, which had an IP holding company excluded as an 80-20 company. Department of Revenue lost in that case, and then there was no legislative response. Nothing happened. Everyone just sort of went on with their lives. And then most recently in Vermont, starting in 2023, finally did shift from a 3-factor formula for apportioning income to a single sales factor formula, as a lot of states have done. And as part of that legislative package, they also repealed their version of the 80-20 rule. And in Vermont, they took the approach of saying, essentially, you can't exclude a domestic entity as an 80-20 company. It just doesn't fit the definition. So on that point, I mentioned that not all 80-20 rules are the same. Some states don't limit the 80-20 calculations to payroll and property factors, but also include a sales factor. That results in a very different outcome, right? If the statute in Illinois included a sales factor, we wouldn't have this case to talk about. We wouldn't be talking about Pepsi. But in those states, taxpayers do potentially exclude as 80-20 companies that do operate predominantly in the United States, but have a lot of export sales, for example. And so it just sort of functions differently. Is that the right answer? I don't know. So what's the point? My hope is just that this is sort of some helpful context for the Pepsi case and the kinds of issues that we're looking at while we wait to see how this plays out in the courts, in addition to how other states have approached similar issues over the last 10 years or so. Second case I'd like to highlight as one that we're watching is Carle. This is a case that's making its way up to the Illinois Supreme Court. Carle, for those of you who don't know, is a large hospital system in Urbana. Prior to 2004, they had a charitable use exemption for all of their parcels. And in 2004, the local assessor started assessing the parcels at their full market value. Carle filed applications for exemption with the County Board of Review, who forwarded those to IDOR with a recommendation of denial. Department denied the exemptions. And then what happened probably needs its entire own presentation and panel. It was a very long, very procedurally complex series of proceedings that went back and forth between the circuit court, appellate court. It went to the Supreme Court. It came back. It eventually led to a decision in February 2020 in which the circuit court granted Carle the exemptions. IDOR and the local taxing districts appealed that decision to the 4th District Appellate Court, and just this past August, the 4th District found in favor of the hospital and upheld the trial court's decision. Much of that 4th District decision was focused on the really complicated history of the case and the really complicated history of property tax provisions dealing with charitable-based exemptions generally and specifically relating to hospitals. From IDOR's perspective, from the department's perspective, what we really care about, what we really want, what matters to our folks is what exactly should we be looking at factually in determining whether to grant an exemption. That's what we care about. We want the maximum amount of clarity. In 2010, the Illinois Supreme Court ruled on Prevena, a hospital exemption case, and it was partly in response to that case that the General Assembly enacted Section 1586 of the Property Tax Code, and they actually declared in the statute, when you go to the section in the statute book, the General Assembly declared that they were enacting it to clarify, quote, the considerable uncertainty surrounding the test for charitable property tax exemption, especially regarding the application of a quantitative or monetary threshold. And I don't know, 13 years later, it still seems like there's a lot of confusion, and here we are. So the general construct of Section 1586 is that a hospital qualifies for the exemption if the value of the charitable services it provides equals or exceeds the hospital's estimated property tax liability. Seems straightforward enough, got that. But the Illinois Constitution states that the General Assembly can only enact statutory property tax exemptions for properties used exclusively for charitable purposes. So there's sort of inherently some tension, in my opinion, between Section 1586 and the constitutional requirement that had to be addressed. The Illinois Supreme Court did address that in 2018 in another case called Oswald. And in that case, the court said, we think Section 1586 is constitutional. It just sort of implicitly incorporates the constitutional requirements, but look, it's really hard to come up with any specifics, so we'll just deal with any other questions or issues about how to apply this standard later. So I think our hope is that that time has maybe come, and that's what we're looking for, I think, with this case going to the Supreme Court. And the last sort of legal issue, the thing that I think keeps the tax lawyers and nerds awake at night, and maybe this is a case we'll have plenty to talk about over the next year or two, or maybe not at all, and that's Moore v. United States. This case could have major implications for the federal tax system, and then, of course, how those impacts flow through to the states would obviously be a concern for a lot of the people in this room. In June of this year, the U.S. Supreme Court agreed to hear the case. It's a constitutional challenge to the mandatory repatriation tax created by the 2017 Tax Cuts and Jobs Act. Oral arguments are scheduled to occur this Tuesday, so very soon, very exciting. The Tax Cuts and Jobs Act ended the unlimited deferral of foreign earnings from U.S. taxable income, and as part of those reforms, the act imposed a deemed repatriation under Section 965 of the Internal Revenue Code, essentially a one-time inclusion of all of these accumulated foreign earnings by treating them as if they had been repatriated. The plaintiffs in Moore are individual shareholders, a couple actually, with a controlling interest in an Indian farm equipment company that became subject to the deemed repatriation. They got a bill from the IRS for $15,000. That's how we got here. Their main argument is that the tax is unconstitutional because it applies to unrealized income. So the question can be framed as to whether, is this realization requirement something that exists in parts of the code, and a lot of us has always thought about as something that is, sort of an administrative necessity. Is it actually a constitutional requirement? For starters, it's worth noting that the government prevailed in the lower courts, lower federal courts, and there's no split among the circuit courts on this issue. So the fact that the Supreme Court granted cert at all is well, I don't know, it's odd. And we don't know where they're going to go on it. They could strike down the mandatory repatriation tax in an otherwise narrow ruling, which would obviously impact taxpayers who had filed returns in 2017 or 2018. And you'd have to look at things like statutes of limitations and how all of that's impacted. The court could hold that the mandatory repatriation tax is constitutional as an indirect tax, which would basically uphold the lower courts and would leave everything alone. Then there's the extreme possibility where the Supreme Court says, yeah, actually, realization is a constitutional requirement, which I think would wreak a certain amount of havoc on the federal tax system that would call into question all kinds of taxes that apply to foreign earnings. So, GILTI, Subpart F, corporate alternative minimum tax. How does the US comply with Pillar 2? What's the revenue impact of that? I mean, it would be sort of tectonic. So I don't know, it's a weird court, right? We've seen them do weird things. So do we end up with a Supreme Court ruling? I'm not a constitutional law expert by any means. It sort of feels like maybe we end up with a ruling that says something like, you can't have a Senator Warren or Senator Sanders style wealth tax, but we're not going to blow a $400 billion hole in the federal budget. But I don't know. We'll see.